Did you see that bearish volume in gold? RSI, bro, there's divergence. RSI, stochastic, they merged. It's MACD, bro. It's like the trend line. Oh my, it broke. Sell gold, dude. It's gone, bro. It's 2000 gold, 2000. Oh, you bears are gonna get smoked. What's happening, people? How you doing? It's been a long time since I haven't shown myself in my videos. I think I'm gonna do so from now on. Um, but anyway, I'm gonna make this video in English. A los que me siguen que hablan español, voy a mostrar cifras que se explican solas y mis gráficas ustedes saben que las ilustro muy bonito, con lo cual no van a tener problema en entender lo que voy a mostrar y pues seguro tienen un nivel de inglés suficiente para entender lo que estoy diciendo. Anyway, that being said, guys, I am not a financial advisor. This and every video I publish is for my personal and educational purposes only. And let's do it. I'm going to show you the numbers behind gold and why it's completely normal that the market is dipping right now. It is not a reversal, and it is not a bear market taking place or starting. It is not a change in direction. There is a trend, and the trend is your friend, and that is bullish. So, um, I mean, I don't think I have to explain how gold moves, right? You understand it's an insurance sort of, or it's an asset that protects you from crisis. And are we in peaceful times right now? Unfortunately, not. Are is the economy, is the U.S. economy? I mean, how is it doing? Yes, okay, fine. It's Nasdaq is historical highs and the S&P and all whatever you want to say. But let's talk about debt. Like how much debt is there? How's the dollar doing? Is the housing sector okay? Like, are there people getting jobs or losing jobs? You know what I mean? So I'm not gonna go further on in regards to that, but we are going to um dig a little bit, just a little bit, in regards to the numbers behind gold. And to do that, I'm gonna start showing you a few websites that I like to use. This is the first one. It's called Insider Week. And here you're going to go to the tool section, seasonality tool, and you're going to select gold, hit calculate, and this should pop up. It shows you a 5, 10, and 15-year moving average of gold. And obviously the current year line, which is in red. And notice how accurate it is. Notice how it shows moments in which gold consolidates, moves horizontally, moments in which it breaks out, moments in which it continues a trend, and so on. And it so happens that 5 years ago, 10 years ago, and 15 years ago, on June 10, between June 1st of June and June 10, market starts to dip. And by mid-June, it changes direction and it continues the trend. And July, we'll see in the charts how powerful July is. But anyway, this is the first website. Second website is where things get interesting. It is this cftc.gov, Commodity Futures Trading Commission. We're going to go to Market, Data, and Economic Analysis. Commitment of Traders. This is all free and it's public. And check this out, Metals and Other. And we can see disaggregated futures only positions or futures and positions. This is very interesting. And again, we're gonna go here and look at the data in metals and other on a long format. Okay, so let's do that. I'm gonna see the futures and options. Long format. This is boring. I know what you're saying, but hey, these are the numbers that people don't like to look, or that they just don't know that they're there. So up over my head, you see the name. We're gonna scroll and search for gold. I think I passed it. copper, gold. Here it is, gold. Gold commodity exchange. We see producer merchants, participants, disregarded commitment traders, options and futures combined June 4th. This hasn't taken into account that dip, FYI, but you'll see how banks and managed money and how they're getting positioned, how they leverage themselves. Check it out. Managed money. Look at this difference. Why? How this? What is this? 197,000 long combined futures and options versus just 16,000 short. Right? Other reportables, long versus short. Like, interesting. Non-reportable positions. Again, there's a long, quite a bigger amount of long positions versus short. Okay. And what else? You go back. If we see just the futures, just to see that. Again, come down. Silver, gold. Here it is. Just on futures of managed money, look at that difference. 172,000 versus 20,000, long and short. 112,000 versus 27,000. Other reportables, long and short position difference. May 28th. Disregarded traders futures only June 4. Change in commitment from May 28th. From May 28th to June 4th, what happened? They decreased by 12,000 long and by 6,000 short. The swap dealers. Managed money, they only decreased by 1,000 and decreased short by 5,000. Other reporters decreased by 200 long, 2,000 short. It's just there. I'm just throwing it out there. Okay, let's go back. I want to show you another part of this awesome website. It's called Bank Participation Report. Bank Participation Report, right here, you see from every month of the year, starting in January, you can see the futures and their options contracts, information of banks. So let's open January, for example. What you're going to see is this table that says the bank type, whether it's a US or non-US, and the number of long futures and short futures. You scroll down until you hit gold, right there, CMX gold. By January, there were 29 banks in total, of which 25 were from non-US, 4 from the US, who had 49,000 contracts on long future contracts, 153,000 short future contracts. Now, I know what you're thinking, that, oh my god, I have to go back every month and kind of like see the difference. I got you. Short contracts versus long contracts. I keep track of the banks that start participating and who get out, I guess. And this is what's been happening since January to June. So obviously you see an increase of short positions and long, okay, and then a dip on both of them. But now, what does that mean? That doesn't mean they stopped shorting and also they stopped buying, right? It's not that. Like, it's, again, because you're talking about futures and options, you would have to sort of try to come up with the way they're leveraging themselves or the way they're trading. Like, are they buying? Like, is their long game divided into only futures or options or options? You know, see, so a bank could be buying a long future contract on gold, but at the same time protecting that position with put options or with short call options. So that's the game. Like that's how you, and those are the numbers I'm showing you. Like you could kind of start to understand in a way, right? So the fact that the short contracts, check this out. Let's look at May, right? May on the futures for banks, and we go down. Where am I? That's much lower. Here it is, gold, CMX gold. We have obviously that big difference between short future contracts and 69,000 only of the long future contracts, 213,000 versus 69,000. So that reflected that dip, right? Kind of makes sense. You're like saying, "Oh wow, that's impressive. Like that's a big difference of short future contracts versus long future contracts." That's May. Let's go to June. I showed you the chart, but here are the numbers. June, the only thing that happens is a decrease. The 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 proportions are still there, but there are less short contracts, less long contracts, future contracts. So, these are the numbers that are interesting to start seeing and how the chart reflects the behavior and price action. Um, and then here you have the options. So this is the interesting part too. So we just seen the futures. Let's go May options. May, options you see again long calls and short calls, and then long puts and short puts. Now, if you don't know how options work, don't complicate yourself. And the only thing you should understand, and honestly, the way I only see, what I only see is the calls. Like long calls, you're betting that the market is going to go up, and you win by the market going up from the price that you buy on. And short calls, downward, vice versa. Like you're betting that the market is going to go down. Of course, you can leverage, and there's all these strategies like straddles and strangles and all these, and they're combinations of long puts, for example, or short calls and then a long put, stuff like that. But what's interesting is just to see the calls initially. Like obviously you can go deeper with this, but I only just see the calls. Like, and again, there's a difference between the short calls and the long calls. There's a slight increment in short calls on May, and that reflected correctly. Like the banks leverage themselves correctly by selling call or buying call short calls, and the market reflected that dip, so they are protected now from that fall by having since May 88,000 contracts on short calls. I hope I hope you're following with me. Bear with me. Bear with me. Bear with me. Okay. We go back. June options. Remember that 88,000 versus 60 something thousand? Check this out. Look what happened in June. Gold. Oh, they're evened out now. From 88,000, there's now 77,800. And from 60 something now, they've added long calls. So what does that tell you? That's showing you that as gold started coming down toward the end of May and beginning of June, because remember this is June, right? They have added long calls at a discount price. We'll see the charts in a minute. Okay, so that's this. Third page, whalewisdom.com. So much information is overwhelming. If you pay, the premium is like a gazillion things you can look at. I personally am fascinated by looking just at Berkshire Hathaway, BlackRock, Bridgewater Associates, all these big hedge funds, the biggest hedge funds in the planet, how do they move their money? Like, what are they doing? What are they buying? When do they buy or sell, right? I have here BlackRock. This is the first thing you see when you click on any of the hedge funds, like all these metrics and things. But what's interesting, again, over my head, holdings. You click on holdings, and then right now I have it selected to add it to, which means, excuse me, which means the companies that BlackRock has added positions to. And in here, you are going to see the sector, and you can organize it by quarter, whatever. You can organize it by all these numbers. But what's interesting is to see. Let's just see the latest ones, out of curiosity. I have them up here, but I just want to see if there's something I missed, just in case. Which I don't think. But anyway, again, up over my head, you see the materials. The finance, the sector, mutual fund, the materials. Whenever you see that says materials, that's usually silver, copper, gold, or the sector of that companies that build stuff, or produce whatever. This is not one of them, but this one, Centera Gold Inc., is one of the companies that BlackRock recently added positions to. And Freeport Copper and Gold is another company that they bought in the quarter 4 of 2019, which is interesting. Check this out, ho. So you see, I'm gonna unselect added to see everything. Oh, here it is. Check this out right here. Materials, just over my head. That first, a call on CF. If I click CF, that's that CF Industries Holdings Inc. CF Industries manufactures and sells hydrogen and nitrogen, produces energy. So this is the sector of the energy, and is reflecting how BlackRock is investing in the energy sector. And these are industries that correlate to each other, and they need each other. So again, ways of looking at how they're moving their money. I'm trying to find the one that said quarter. Let's see, it's new, I think. The new ones that BlackRock has added to. One of them said quarter 4 of 2019, which is, here it is, FCX, Freeport Copper and Gold. That's the one I had opened here, but I wanted to show you by clicking on the list of the actual, BlackRock acquisitions. So again, just over my head right here, the one I'm highlighting with the cursor, quarter 4 2019. We're gonna go into that time period in the charts in a little bit, because you're gonna see the similarity of gold behavior from quarter 4 2019, when BlackRock bought this company, to the behavior gold is having today, okay, in the last few months. So bear with me. That's one, FCX, which is this one, Copper and Gold Inc. And by the way, you can dig into these companies just by themselves. Like, for example, look at this, the increment, the change, right, in their stock, like who, and you can see who's buying this, right? If I go and see, when are they, like, look how many people slash institutions, hedge funds, companies, whatever, they're investing into gold and copper in the first quarter of 2024. Now, where was gold in the first quarter of 2024? It was at the highest resistance. It was historical max. Divergence, bro. It's like the RSI. It's overbought. Just sell it. Oh my god. Well, there you have it. Look how many gazillions people are like investing into, and price was at the resistance. So just I'm throwing that out there. Okay. So this is awesome. You can click on any of these and just see who are these people. Like you can see their websites, you can see what they move. Like just randomly, I just clicked on this one. Battle Fraser Investments Counseling LLC, whatever, and whatever. Yeah. So what else? BlackRock. Um, so I showed you that quarter 2024 right here, right? And let's see what else. Materials. This is what was the CF? I think it was a CF. No. Central Gold. Centera Gold. What's that ticker? I'm trying to look for that ticker. CGAU. That was another one they bought. That BlackRock bought. That called my attention, which is why I pulled it out. CHG, whatever. It's. I hope I don't have to get. I don't have to go too far though. Google puts. This is awesome. Let me see something. A cat. Here, I'm gonna find it here. What was it? Materials CF CG. Where is it? Premier Impact Acquisition? Nah. Alright, whatever. I pulled it out. Centera Gold Inc. Like it's another exploration, development, and operating of gold and copper properties. Like BlackRock is investing in gold. Period. Just to make things shorts. Let's see Berkshire Hathaway, just out of curiosity. See what they've been up to. Holdings. Any materials? Up over here, materials. I see materials. But that's quarter 3 2022. See, I don't care about that. Alright, whatever. That's the third website I wanted to show you guys. It's to understand how and when, why money is getting moved around. Now let's look at the fun part. Charts. The chart. This is what I think is going to happen. I'm gonna hide this so that we start fresh. Check this out. I want you to take a mental picture of this area from here, where gold made that wick at the top of the historical highs, and how it consolidated, and the way it broke out, the way it accumulated during this small like range, and then it broke out again, the same, almost the same distance, basically the same distance, right? And then there's a wider range of consolidation. So just record this shape, record that form. Check this out. Remember when BlackRock bought that company and added positions to that gold and copper? Quarter 4 2019. Let's see what happened in the quarter 4 of 2019. Have you seen that meme? Have you seen that? I know the one I know you know. I know you know. I'm talking. I know you know. Check that out. Is that not a deja vu for some reason? Somehow? How do you explain that? How do you explain gold having been in the historical max of 1,340 to 1,365, hitting that resistance, consolidating in what could be interpreted as a bullish triangle, a flag, a breakout, a small accumulation phase, tiny range, and then a continuation breakout, almost the same distance, basically more than that, and then a wider range. And you want to see what's something interesting? Look at the date. Look at the date in which gold started coming down, June 19. And then look at the date when it stopped, when it pops, July 2nd. Watch. This is when BlackRock bought that company. Once it broke maximum highs. They were late, by the way, obviously, but it tells you something. They haven't sold. They're holding that. And so now you see this, and I just can't. I'm like, wow, this is awesome. This is very interesting. How almost exact is today's behavior to 2019, and the time and the period. Like, what was happening in 2019 and what's happening now? This was just before the pandemic, bro. Like 2020. But by the way, I believe it was late 2019 when China started releasing those videos, and it wasn't until like 2020 March 2020 that it got to this side of the world, right? So it makes sense that late 2019 gold just popped, and from 2019 on, it was a few months of kaboom. Like, it was until August 2020, and even with the horizontal consolidation and that shorter term bear market from, for example, August to March of 2021, it never reached that resistance that it broke out of in 2019 and when BlackRock bought. So if things are lining up, right? And today, what we are seeing, and by adding, joining the dots again with the numbers I showed you, and then how the banks are leveraging themselves, and then short interest, and then all these options and these future contracts are getting kind of like leveled up. Is like, it's so interesting to see how banks and institutions are leveraging themselves and positioning themselves. And by the way, how they manipulate the market too, because in order to create liquidity, there must be volatility, there must be news, there must be economic data, there must be for gold, unfortunately, geopolitical conflict. I hate to say that, it's so sad, but it's true. And what's happening? How is the world what's happening in the world right now? US economy like walking in a rope, like about to maybe or not collapse. It's like it's so uncertain right now, the debt, whatever. Elections are coming up. God knows what's gonna happen if whatever happens. How is the conflict going to be managed? You know what I mean? So gold is not going to come back down lower than 2,100 in the next few years. That's what I think. This is what I'm going to show you right now. I'm going to dig deeper now into the chart and show you how I interpret now the price action. So what I've done here is, having seen such degree and level of similarity in the form and in the dates of gold behavior, like it broke out, it consolidated by June, by May, dipped on June, July popped. It's doing the same thing. So I'm just gonna trade probability. Statistically, what's the probability based on what we've been discussing that gold, let's say, indeed breaks lower and retraces to a bear market lower than 2000? What's the probability versus the probability of it inducing selling, reaching a discount price level, which we're going to see is interesting enough for the rebound? based on seasonality, on how gold starts to move by the end of June and July. So that's why I have mapped and I've made the best effort I could to literally illustrate both the amount that gold could retrace, the amount it could extend itself to the downside, the moment in which it could and might find the bottom of this corrective wave, and what could happen from there on. That being said, I have used my Fibonacci retracement tool to measure from February's and from basically from March's breakout to mid-May, that big long up bullish push. This is a Fibonacci retracement to the 50. Check this out. If I zoom in, there's something very interesting. There's a gap in volume between these two candles. And I could get into this whole topic of algorithmic price delivery and how markets are moved by algorithms. Is not new, but it is a fact. Like, it's algorithmically speaking, these levels are exact and they're precise, and the market seeks those to rebalance those spaces. Okay. For example, let's go to the 1 hour chart real quick. I have this rectangle here illustrating this gap, right? This imbalance between sell side imbalance. There's another one right here, like this space, this empty space in which there's only a bearish candle but not a bullish intent to at least retrace some of that bullish momentum. The fact that there's not a wick or another candle pairing it in the future is going to want to pair that. So, and when you measure those spaces, which is from these wicks, like literally the empty space, the middle, where is that line that I have on that rectangle, is the same thing as saying the 50% retracement of, and those are magical points. Look at where, for example, after it broke out, look where it retraced to, and from where it made a bounce from to continue the bearish breakout. Bear with me. If I extend that, look where the candles closed, where the body of this candle closed, and where this one obviously started, and they respect it. It's just that wick. So that space is balanced now. And what happens? You have a bearish sell imbalance, a bullish, and now a bearish. So you have bear imbalanced that got paired with this bullish, but now you have a bearish breakout. What comes next? A bullish pairing of that range any moment. That being said, I could keep going. Let's show you one more. Here it is, right here. Like, once you see this, your eyes they get like super agile. But check this out. Right there. That wick to this wick. If I extend it, the market dips into that area, and that's where it shows. It leaves a support, and eventually is what gets paired out. Is what the algorithms go seek liquidity and generate that volatility and those strong push. So again, this you can see in the 1 minute, 5 minute, 1 hour, daily time frame, weekly time frame, and the gaps are the same. And it's actually even more powerful because that means there wasn't orders there. There's an imbalance in volume. It was too much volume, too much bullish volume that needs to get eventually balanced out with bearish volume, meaning that there has to be selling orders here to reflect a bearish candle, whether it's in a form of a wick in a daily time frame that represent candles in lower time frames, or a legit daily closed bearish candle from there and then a rebound. Why a rebound? Well, because that's how market should behave starting in July. That's Tuesday, July 2nd. Obviously, it could happen July 1st, July 2, July 3, July 4, but the point is, based on my seasonality chart, not my seasonality, the seasonality chart, July 1st has to July 4th. Just starting July, it's bullish. So like, again, statistically, probability, probabilistically, whatever that's a word, but you understand what I'm saying. Like, what's the probability? Should you continue selling gold after it shows, after it consolidates a little bit, even if it breaks out support? Because that's how markets move as well. They want you to sell so then they can buy you out, which is why bears are going to get stopped out. All right. So just to finish, let's almost done, people. Thank you. This is what I think is going to happen. I project that that market is going to open with a gap. A gap in candles, in the daily candles. Maybe the Sunday night open maybe opens at 2,284. I don't know. I'm gonna throw a number out there, but anywhere lower than the body of where market closed, which is 2,293. So I want to see a bearish imbalance in volume. I want to see a candle open somewhere there, right there. I think you can see it, right? And that empty space of bullish orders. And then I want to see that candle trade, that daily candle trade below 2,275, or maybe close the gap, leave a wick, and then come down a little bit to that wick right at the bottom to the left, 2,277, and then stop a little, come back and grab that liquidity from there, because that empty space must get filled, which could and should retrace the big bearish push to, let's go to the Fibonacci, let's measure the wick to the wick, and let's see what is near the 50% retracement. Let's go to the 4-hour time frame, for example. 4 hours, to be even more precise, we measure the actual move within 4 hours. So, okay. Look at that imbalance. Look at this imbalance. Right? Right there. So that 50% of the imbalance, or rather the 50% retracement of the latest big dip in gold, matches with an imbalanced area that so happens to be quite in a very strong pivotal price range, where previously gold showed struggle to break. So all of this is a strong pivotal area. Meaning price eventually seeks to retest those areas, struggles again, but eventually breaks them. So let's zoom out. I'm gonna extend this. I want to see gold here by Tuesday or Wednesday, because that's going to start defining next week's bearish continuation to finish the month of June near 2250 to 2240, so that by July it has successfully balanced that gap and reached a, a low enough price for institutions to say, all right, let's do it, let's buy it, because there would be a lot of retail traders selling, and who are gonna get stopped out. Okay. Lastly, you should see a V shape. I'm gonna leave at the end of this video another video of these V shapes and A shapes patterns that I personally like to identify in charts. Awesome way to identify manipulation phases, but you should see a very pronounced spike down and spike up move around this price range of 2240, between 2250 and 2230. Just a very violent down move and then a very strong up, basically even, creating this. And then that's your ultimate signal to buy. That's like okay, they're in, they bought, it's gone, like Bitcoin. And then what I think could happen, almost done, bear with me, please bear with me. What I think is going to happen next is a cup and handle, a gorgeous cup and handle in the 127 extension level. This is negative because if I only use the Fibonacci retracement, and the extension, you know, would show, if I put 127, it would show it down here, 127. But I'm not interested in how much it could retrace even. I want to see how much after it retraces, how much it extends. So that's why I put negative 27. So that's reference to the 127 retracement extension, and then the 161.8 extension, and then a symmetrical extension, symmetrical swing target, which is 100%, like 2 times the push, which is why what I'm illustrating. So the bullish flag, right? If you measure from where it breaks to its high, if you measure based on this as precisely as I tried to illustrate it, if you measure it, it matches the 161.8 extension level, and that is at $2,710 an ounce for gold, just from June probably to the end of the year. So anyway, I think I don't think I'm leaving anything out. I've done quite a nice complete homework for you guys to understand what could happen. Now here, just my eye kind of caught. Let's just draw something like this to see what happens, right? Yeah, kind of. I don't know. Could look like something, you know. It could look something like that. Anyway, guys, I'm gonna stop this video right here. I really hope this helps you. Again, go check out those websites I left. Yeah, we'll see you next time. Okay. You're snubbed out. Don't bear with me.